We have a contrarian point of view here. We think the bigger risk in the next 1 to 3 years is deflation, not inflation. And it's both good and bad deflation. We're already seeing cyclical deflation in the pipeline. We've got commodity prices down, even oil, 30, 40, 50, 60, 80%. And it's because China's in recession, Europe's effectively in recession, and we think the US is in recession. So you've got deflation coming in the pipeline, and we have a massive inventory buildup that is actually shocking. Nike, for its recent quarter, reported that its sales were up 3% and its inventories were up 44%. In North America, its inventories were up 68%, and the inventory in transit is up 85%. This is going to overwhelm retailers, and the only way they'll clear their shelves is to discount aggressively. We're already hearing Walmart, Target, and others talking about discounting. We think cyclically we've got deflation, and then secularly, meaning longer term, we believe we have deflation because of innovation. Now that's good deflation. You cut the price of something, units will increase. So we think we're going to see some booms in categories of innovation. But at the same time, if we're right on that, there are a lot of products in the old world that are going to be obsolete, and they'll have to cut prices. That's bad deflation. So we see deflation, frankly, all over the place. And the Fed right now is looking at 2 lagging indicators. It's looking at CPI inflation, and I just told you what's in the pipeline, and it's looking at employment. And employment, I think what's happened there recently, companies had so much trouble hiring during COVID that they have decided to hoard labor. And even though business is kind of fraying at the edges, they're keeping their employees because they don't want to go through that again. If we're right on what this inventory glut is going to do to margins, we're probably going to see some deterioration in employment as well. So the Fed will pivot. We just saw a liquidity crisis in the UK. Pension funds, because the increase in interest rates has been so rapid, led by the Fed, pension funds were offsides in terms of their derivatives, and there was a run, margin calls. This has happened just recently, and that is a sign that there's a liquidity crisis brewing out there because interest rates have moved up too fast. We think the Fed is now making a mistake. A big part of our research is trying to figure out what is possible. We don't want to be optimistic for optimistic's sake. We center our research on something called Wright's Law, which is a relative of Moore's Law, which people know from the semiconductor space. And it helps us identify how quickly costs associated with different technologies are going to fall over time, and therefore how much access people are going to have to this new technology as prices come down. But you're right, the Wright's Law is based on unit demand. Are we going to be able to supply this demand? Lithium is probably one of the most prolific minerals out there in the world. It's everywhere, it's ubiquitous. It takes a very long time to build a mine. I think it's 3 years. But I think Tesla has changed the pace of the lithium industry, the lithium mining industry, by basically saying, this is what we're doing, this is how we're going to scale, we'll take all you can get. And so they've taken the risk out of a lot of commodity producers saying, we will take it. We think the electric vehicle market is going to scale so quickly, and even more so now that oil prices have skyrocketed. It's been able to maneuver around shortages. Not only does it by encouraging production, but it also does it by changing chemistries. For example, cobalt, which is mined primarily in the Congo, was critical to battery production. Tesla's moving away from cobalt completely and is moving away from nickel to lithium iron phosphate, which is much more available. So an innovator has to also be pretty flexible and think about the physical constraints and be realistic about them. And in fact, it's really interesting when I hear Wall Street talking about innovation, they're really coming at it from a negative angle. They're talking about the reasons it would happen. And one of the reasons is that Wall Street and a lot of investing has become very benchmark sensitive. It's gone passive in a way. And so there's less and less research being done. There's no reason for many analysts to follow stocks because they're not in their benchmarks. Those are the innovation stocks that we follow. And I believe that's why we have the best research. We're very focused on innovation and how likely or not not will scale during the next 5 to 10 years. Social distribution is going to break down barriers that have existed. Distribution has been a big barrier to entry for a lot of funds, to be honest. As you were saying, Kyla, earlier, non-accredited investors have no shot at venture funds. So Titan is breaking down barriers, and we're grateful for that. Innovation solves problems. Innovation solves problems, and we have a lot of problems. And actually, innovation gains more traction during tough times because consumers and businesses, if they're afraid, they're willing to change the way they behave. There's a lot of inertia in human behavior, and they're willing to change. In terms of an unmet need, that's why I founded ARK. I saw the traditional asset management world focused on public equities going passive. And at the same time, we saw this explosion of innovation. You know, the seeds were planted a long time ago. The technologies are ready now. The costs are low enough. It's just so ironic. Because of what happened in the tech and telecom bust, people won't go near a lot of innovation these days. That's a good thing. That's a good thing from a portfolio manager's point of view. I know we are not in a hype phase, but I do feel the unmet need that we are filling is innovation as a special asset category, because benchmarks and passive are all based on backward-looking indicators. The stocks in those portfolios are there because of their past success. If we're right, and these 5 major platforms, which involve 14 different technologies, are going to disturb, if not destroy, the traditional world order. If we are right, then it is imperative that investors have, I would say, a very good allocation to innovation, however one wants to define it, to innovation, so that they're looking at the future and, riding the coattails of these new technologies and these exponential growth trajectories that we believe are going to be transformative for the world. We have a 5-year investment time horizon generally. I shouldn't say generally, always 5 years plus. The return expectation is somewhere in the 20 to 25% per year range. Now, for our ETFs in the public equity markets, these are more mature companies, that number is 15%. So again, this is just filling out a space that is where we should rightly be, because we are so exclusively focused on disruptive innovation. Our research is the filter. Really do believe that we have the best research on innovation in the financial services industry. Why? Because we've dedicated ourselves to innovation in both the public and the private markets. And now we can take companies from early stage to mega cap, which we think is going to be a real service to our clients, but also to the company.